going to be a fun talk because I don't normally do predictions. When you make a prediction, mentally you get sort of anchored to that event or that number, whatever the prediction was. And if the stock market goes in a different direction, then as a money manager, I may be experiencing a strong psychological pull to make bad decisions because my prediction was over here and the market's over here. So I normally don't do that. However, with that said, I'm going to get out on some thin ice and I'm going to talk about making a prediction. And now we've been in a bear market since last year. And so predicting the start of that bear market wouldn't really count. It'd be like cheating. What I want to talk to you about today is how I'll know to predict the end of the bear market, when it's going to end. And since bear market bottoms present the best investment opportunity, perhaps for a generation, this should be of interest to all of us. Now, the tea leaves that I use in this prediction is what's called an interest rate spread. The term interest rate spread refers to the difference between two different interest rates. Now, today we'll talk about the spread between the 10-year Treasury note and the 1-year Treasury note. The difference in these rates can give us an insight into the economy and the direction of the stock market. And the keys to this analysis are which rate is higher, how far are the two rates apart, and are they moving closer to each other, or is the spread widening? This particular spread is the most accurate predictor of recessions that we have, and that's why we're focusing on this one. In healthy economies, long-term rates are higher than short-term rates, but not today. Since early last year, the 10-year rate has been lower than the 1-year rate. You can see that on the screen here. And when we subtract the 1-year rate from the 10-year rate, all of a sudden we have a negative rate. And this is called an inversion of interest rates when short-term rates are higher than long-term rates. Now, the next chart shows the difference in the long-term and short-term interest rates from the 1960s till now. And most of the time, the economy is healthy. The spread is positive, and the blue line, which represents the spread, is above the red zero line. However, on the right side of this chart, you can see that interest rates inverted and the spread dropped below zero last year. Now, the 7 most recent economic recessions are highlighted in this chart in gray. And each of these 7 recessions was preceded by a dip of that blue line below the red line, where the spreads became inverted. Even if it's only for a brief time, it happened every single time. Now, statistically, 7 is not a great, huge sample size, but 7 out of 7 is a 100% record, and a perfect prediction rate in this business is really, really rare. So we pay attention when we see one. Now, a year has passed since the inversion in rates began. So why haven't we seen a nationwide recession like this inversion would predict? In certain industries have been a recession. Real estate began to suffer 20 months ago when the Federal Reserve began raising interest rates. And the LA Times last week reported that home sales are 19% below where they were a year ago. Factory production is also down, maybe not as bad as real estate, but it's down. And both tech and finance have seen significant layoffs. So some industries clearly are in recession. However, other industries that were beaten down during COVID, like restaurants, retail, and hospitality, have rebounded strongly. And this sort of masks the underlying weakness in the economy. Now, I've heard the term recession used, meaning that more affluent people can continue to spend on travel and retail and restaurants, while less affluent have to cut back. Like, this is something new. This has always been the case. People with money have always had more economic opportunities than people without much money. However, the data on this chart shows that savings levels have dropped sharply over the last few years. So even the recession may be in the process of running out of gas. Now, to go back to our interest rate spread chart, there's one thing that is almost always present is a delay from the time interest rates invert to when the recession actually begins. Now, the government is the official declarer of recessions, and their formula requires at least 2 full quarters with 6 months worth of economic shrinkage in the economy before they're going to declare a recession. So we've got at least a 6, maybe as much as a 9-month lag before a recession is declared after interest rates invert. Now, as an investment manager, this time lag also gives us a good heads up on where the stock markets are growing. My friend Tom McClellan runs a newsletter company called McClellan Financial Publications. And Tom is one of the best visual traders I've ever encountered. And you'll see what I mean by visual trader here on this next chart. He recently posted a piece that looked at the interest rate spread and what that can tell us about the end of the bear market. Most interest rate inversions tend to be short-lived and relatively brief. And bear markets end on average about 22 months after interest rate inversions reverse and begin to correct themselves. Now we can see on McClellan's chart, which shows how the bottoms in the interest rate spread, which is the red line on the bottom, match up really closely with the bottoms in the stock market, in this case, the Dow Jones Industrial Average, as long as the interest rate spread chart is shifted forward 22 months. That's what lines up these bottoms. So this shows us real clearly that we've got a 22-month lag between the bottom of the interest rate inversion and the bottom of the stock market. Now, when interest rates eventually do reverse, hopefully soon, the data access at the bottom of this chart is going to tell us when the stock markets are likely to bottom. Now, a year ago, when rates first inverted, many of us hoped that this 22-month lag pointed towards a stock market bear market end and a bull market beginning sometime in early 2024. However, that 22-month lag time really begins not when interest rates invert, but when the inversion begins to correct itself and the spreads begin to get narrow, when that red line starts to turn around and go back up. Now, this is significance of this is in the length and the depth of the inversion. We aren't done yet. As of today, the interest rate inversion has not bottomed, and it's continuing to get deeper and deeper, which just postpones the projected end date of this bear market. Now, the point of greatest inversion is the time to count forward from, and we haven't yet seen that condition. If interest rate spreads were to contract today, the 22-month time frame would suggest that the current bear market will not end until mid-2025. So if you're looking at your shadow ridge accounts and you see a big cash component rather than fully invested status, this is one reason why. Despite the stock market strength earlier this year, interest rate spreads suggest strongly that this bear market hasn't ended. There's going to be at least one more leg down, possibly more, in the stock markets before we're done.